This video is brought to you by togetherbudget.com. Index funds are a type of investment vehicle that aims to replicate the performance of a specific stock market index, such as the S&P 500. On the other hand, active funds are managed by professional investors who attempt to beat the market through their investment decisions. The key difference between index funds and active funds is their investment approach. Index funds focus on matching the market's performance, while active funds try to surpass it. When evaluating which option is best for your investment portfolio, consider your risk tolerance, time horizon, and financial goals. An index fund is a type of investment vehicle that aims to track the performance of a particular stock market index, such as the S&P 500. This means it holds a representative sample of securities from the underlying index. In contrast, actively managed funds employ a professional investment manager who actively selects and trades individual stocks, with the goal of beating the market's performance. One key advantage of index funds is their low operating costs, as they don't require expensive investment managers or trading strategies. However, some argue that index funds are limited by their inability to adapt quickly to changing market conditions or exploit new investment opportunities. Active management involves hiring a professional fund manager who actively buys and sells securities to beat the market's performance. The goal is to outperform a benchmark index, such as the S&P 500. Active managers try to time the market by making predictions about future stock prices, economic trends, or interest rates. They often use complex investment strategies and techniques. However, active management comes with higher fees and costs due to the fund manager's salaries, expenses, and other charges. These costs can eat into your investment returns. On the other hand, index funds track a specific market index, such as the S&P 500. They hold all the same securities in the same proportions as the underlying index. Investors often debate between index funds and active management. Index funds track a specific market index, providing broad diversification at a low cost. Active management involves hiring a fund manager to pick individual stocks or bonds with the goal of beating the market. However, this approach comes with higher fees and risks. Index funds offer simplicity and ease of use, as they require minimal maintenance and can be easily diversified. In contrast, active management requires more time and effort from investors. Ultimately, the choice between index funds and active management depends on an investor's individual financial goals, risk tolerance, and time horizon. Both options have their pros and cons. Scene 1. Historical performance comparison between index funds and active management. In the past, active management often outperformed index funds due to its ability to adapt to market conditions. Scene 2. In recent years, the tide has shifted in favor of index funds. Studies have shown that over the long term, index funds tend to outperform active management. Scene 3. The success of index funds can be attributed to their passive investment approach. By tracking a market index, they avoid trying to time the market and minimize trading costs. Scene 4. In conclusion, while active management may still have its place in specific market conditions, index funds have proven to be a more reliable choice for long-term investors. Their consistent returns and lower fees make them an attractive option. Tax efficiency is an essential aspect to consider when investing in index funds versus actively managed funds. Index funds, which track a specific market index, tend to be more tax efficient due to their lower turnover rates and minimal trading activity. Active management involves frequent buying and selling of securities to try to beat the market. This trading activity generates more capital gains distributions for shareholders, making it a less tax-efficient approach. In a taxable brokerage account, tax efficiency can make a significant difference in investment returns. Index funds offer a more tax-efficient solution due to their ability to minimize trading activity and reduce capital gains distributions. For retirement accounts or tax-deferred vehicles, the distinction between index funds and active management may be less critical. However, even in these cases, tax efficiency remains an important consideration to ensure long-term investment success. In conclusion, choosing between index funds and active management depends on your investment goals and risk tolerance. Consider the costs associated with each approach, as fees can eat into your returns. Tax efficiency is another critical factor in making a decision. Ultimately, it's essential to assess your personal preferences and investment objectives before choosing between index funds and active management.